Well, welcome everyone to tonight's asset protection webinar. For those of you that are brand new, this is an ongoing series that's been going on for well over a decade, and we usually have two or three a month webinars of various topics that are somewhat related to asset protection. Um, Last week we talked about estate planning, and the week before that, I don't know, who knows, but this is an ongoing thing that we've. Why is it asking me if I want to leave the webinar? We've had some really cool people on in the past. Kevin O'Leary, presidents of corporations, presidents of IRA companies, attorneys, accountants. This has been going on a long time, and we hope that you're enjoying this. And future webinars, I think next week we should have Stacy Acevedo. She's with Mike Koval. She should be on talking about what's happening in the market and what's hot right now. We've got Preston Knight, an attorney, talking about how to set up a business to manage all your investments and some of the tax perks and being able to write off things this way, having a business that you couldn't otherwise have. Some of you go, well, I don't have a business. Well, you're investing. That can be a business. And so we're going to talk about that and bank on yourself. And there'll be 4 or 5 more webinars before the end of the year. So pay attention to your emails. And then all of these are usually, well, all of these are recorded, placed on our YouTube channel for 30 to 60 days, and then we rotate them on and in and out. And so there's hundreds of recordings we've had. A lot of them are available on the YouTube channel. If not, you can call customer service and tell us what you're interested in. And chances are pretty darn good we've got a webinar on that particular topic. And then pay attention to our Facebook page. You can find us at protectwealth.com by liking us or connecting with us on Facebook. And we try to always have brand new tax tips, usually every week or sometimes 2 or 3 a week. Just fun little articles or fun little blurbs to give you some ideas. Are you deducting this? Are you not? And then finally, our 3-day summit that's coming up. It'll be the last one of the year. This is usually the most well-attended summit that we have. People trying to get their affairs in order before the end of the tax year or get them set up for the beginning of the new tax year. It's November 13th, 14th, and 15th. Yes, it's a Monday, Tuesday, Wednesday event, and it'll run from 9 to 5 or 9 to 4 Mountain Time, so you can kind of adjust for that. The theme of the class has been for over 20 years, a lifetime to accumulate, 3 days to protect it. Give us 3 days. We're really good at teaching asset protection. So those of you who've been to the class, I think we're very good at this. We've got close to 1,000 now 5-star reviews and hundreds, probably thousands in our filing cabinet that aren't on Facebook or Google, but a lot of really happy students over the years. So invite you to join us. And then finally, before we do anything, anytime we talk tax and legal, there's always going to be a disclaimer. We can teach correct principles, how they apply to you. That's really for you and your accountant, your attorney. So we'll give you opportunities to meet with our people. So pay attention to that, because there will be an opportunity to meet with Talon at the end if this is something that has an interest for you and your particular business and your situation. So with that, I'm really excited to introduce Talon. And this has been, we've run an asset protection hotline for almost 25 years. I can't tell you the number of people that have asked us where they go to get their business evaluated, and we really haven't had a good solution for that. But it comes up, as you know, but students, as not just when you come to buy and sell a business, but it comes up for divorce settlements. It comes up for tax situations. It comes up with so many times what is my business really worth? And I'll let you handle that. But we found somebody that we really feel confident in bringing to our stage and introducing to our students. Talon comes with years of experience and great credentials, and so we're going to turn the time over to Talon Stringham. Let you teach, but we'll be in the background if you have any questions, and then students, if you have any questions, hold those. Maybe his presentation, I've gone through his slides. It looks really good. It's designed to answer your questions before you ask them, but write them down, and chances are he'll answer them as we go through. If not, you can type them into the Q&A screen, and we'll leave some time at the end to be able to answer your questions. So, Talon, maybe tell us a little bit about you and what we're going to talk about tonight.
Sure.
Thanks for being on.
Yeah, thanks for having me, and thanks to everybody who's on the call. I really appreciate the chance to talk and hopefully teach you a little bit about business appraisal, business valuation, and how we as appraisers kind of go through the process. So, thanks for taking time out of your evening to spend a little bit of time with me, because it's something that I enjoy, and I enjoy helping people learn how to figure out how much their business is worth. Just a little bit about me. I'm a CPA, so I have a CPA license. I'm accredited in business valuation by the AICPA. I am a certified fraud examiner, and then I'm also an accredited senior appraiser, which it's a designation in business appraisal. I've been doing business valuations for over 20 years, and I've done them in all sorts of settings, and I'm just happy to share a little bit about it with you guys. So so the goal tonight is to kind of go through a little bit about what a business appraisal is, what we do, how we do it, why you need to get one, or why you would want to get one. And then hopefully at the end, we'll have a little bit of time to go through a couple of quick case studies to kind of show you the types of things that we consider. So first off, what is a business valuation? Essentially, it's the process of determining the value of a business or a part of the business. It could be, that we're trying to value a minority share, a 50% share, maybe a 10% share, or it could be the value of an entire business. But in any case, all three of those, we kind of go through the same basic types of processes, and we'll go through some of that tonight. So why do you need to know how much your business is worth? First of all, for most business owners, the business itself can be perhaps their biggest asset. For most people, maybe their home is their biggest asset, but for a lot of business owners, the value of their business exceeds the value of their home. And knowing how much that business is worth can help you make decisions. And if you're a dispassionate business owner, knowing how much your business is worth on a continual basis can help you know when to get in and when to get out. Not all business owners are like that, obviously. Sometimes it's our baby and we get emotionally attached to our business. But, for some of us, knowing is a good thing so that we know when to get in and get out. Approaching retirement, you might want to try to sell your business. And going through that process, knowing how much your business is worth will help you be a better negotiator. Unfortunately, litigation is another big reason. I think at the beginning we talked a little bit about divorce cases, shareholder dispute cases. those are a big part of my practice, and I value businesses all the time in that context, for people who need to figure out what the value of their business is for marital dissolution purposes or business dissolution purposes. And unfortunately, it's a fact of life, that, at some point, the business does need to be wound up. And unfortunately, a lot of times it comes about through litigation. And then another big one is gift and estate tax planning. And that's probably a pretty big reason why a lot of you are here, is to know how business valuation works within the business, or the estate tax planning context. And there's ways that you can value your business and transfer your business, and at the same time minimize the estate tax, that you might have over time. And it kind of depends on each individual circumstance, but there's a lot of estate tax planning that can be done if you know the value of your business, or a portion of the value of your business, so that you could put that estate plan together with the help of someone like me, but also an attorney. We talked about a couple of these. Insurance coverage is another reason to know. A lot of times, partners will have buy-sell agreements, and getting the appropriate amount of insurance coverage, if you have a fair market value clause in your buy-sell agreement, then you a lot of times will want to have insurance coverage sufficient to be able to pay that out. And so getting the appropriate amount of insurance coverage can be a big reason, or can be a reason to know what the value of your business is. Another maybe under the radar thing is, in the process of identifying how much a business is worth, can a lot of times help identify areas that could use improvement and ways that you can grow your business. And we'll get into some of those a little bit later on, but it's a very good tool for determining how to grow the value of your business, not just knowing what the business is worth, but it also can help you know where to go next. So I've done a lot of work in terms of helping people decide how much their business is worth, so that they can figure out how to sell their business, whether that be to a partner, whether that be to a third party, whether it be to, hey, we want to sell to our kids, and kind of figuring out, okay, what's a fair price in terms of figuring out what the value of this business is. And then we talked a little bit about litigation, the shareholder disputes, embezzlement. I've actually seen cases where embezzlement has changed the value of the business. Sometimes you can have a contract dispute, and really part of the damages of that contract dispute may be a diminution of business value, or possibly even a destruction of business because of somebody's breach of a contract. And it can have that much impact on a business. And so sometimes doing a business valuation for purposes of that will come into play. But one thing I did want to touch a little bit more on, like I said, was the gift and estate tax planning. If you want to minimize your estate taxes, one of the ways to do that is to transfer the value of a business either to a trust, or perhaps to children over time, and gift them minority shares. And as you do that over time, you can minimize kind of that transfer tax later on. And so a lot of times with the attorneys that I work with, we will value the business and we'll value kind of a minority interest in that business, and then allows clients to put those assets into a trust at a lower price, and then allow those assets to grow within the trust, and therefore save on the transfer later on. This comes into play with the lifetime gift tax exemption, and where basically the government allows a certain amount of money to be given away in the course of a lifetime without having to pay a gift or estate tax, and the limit gets adjusted every year. The situation that we have right now is actually that right now, as we speak, there's around $13 million exemption, or just shy of 26 million for couples. And this has a sunset provision in it, to where starting January 1st, 2026, it basically drops this number in half. And if you don't use it now, you're going to lose it. So there's a little bit of an incentive right now for gift and estate tax planning purposes to go ahead and use some of this exemption now while you have it. And obviously the utility kind of depends on how how big of your business is, but 6 million isn't a big number in terms of figuring out what the value of a business is. I've seen plenty of businesses that are much more than that. So says, how does putting a minority interest into a trust save money? If you think about, and we'll kind of go through this a little bit as we go, but the answer to the question is typically a minority interest is worth less on a pro rata basis than the value of the entire whole. So if we have a business that's worth $10 million, once we get into discounting for minority interest and lack of control, which we'll kind of go into that in a little bit later on, but those interests are typically not worth, if we have a 10% interest, it wouldn't on a $10 million business, that interest would not be worth $1 million. It would be worth something less than $1 million. And so by putting it into the trust in a minority interest situation, it allows you to transfer the value of something that's worth less into that trust, and then later on it grows. Hopefully the value grows within the trust as well. So maybe we can come back to that question a little bit more if we don't answer it, if that answer isn't sufficient. But and again, there's other gift tax considerations. I'm not an attorney, and so some of this is my knowledge of working with attorneys, but my work is used very much by the attorneys in figuring out what some of those gifts are and how much those gifts are worth, which then plays into the entire estate plan. Okay, let's get into a little bit of how we go about valuing a business and what we're trying to do. And the very first question that we ask as an appraiser is what's being valued, and what's the context of doing that valuation. Are we looking at specific assets? Are we looking at an equity asset? Are we looking at something else? Some of the business appraisals that I do actually are a valuation of a set of assets rather than a set of equity. And so we have to kind of define, first of all, what it is that we're valuing. Is it an asset piece? Is it an equity piece? If it is an equity piece, how big of an equity piece is it? Are we looking at 100% of the company? Are we looking at a minority interest? And either way, is it a controlling interest? Is it a non-controlling interest? Depending on how the terms of the shareholder agreements are set up. Are we looking at a liquidation? Are we looking at a going concern? The other thing is, how are we defining value? Fair market value has a very specific definition. Willing buyer, willing seller, everybody knows everything about the company and what price would they come to, versus a fair value definition, which is typically a litigation standard. And so can be state specific in terms of how that's defined. Fair value also has a different meaning when we're looking at fair value accounting, and how assets get put onto the books when there's an acquisition. And investment value is yet another way to define value, meaning what would it be if you could have control but also maybe make specific changes to the value of the business. And so each one of these standards, or each one of these things, is something that we have to consider before we ever even get started in terms of doing evaluation. For the most part tonight, we're going to talk about fair market value when we're talking about these things, because that is one of the most common standards of value. One item that I thought of while we were sitting here, and I neglected to put it on the slide, but also the date of the valuation matters quite a bit. As we all know, value changes over time, and it can go up and down even on a daily basis if we look at the stock market. And so defining the date at which we're doing the valuation is also another big concern in terms of figuring out the value of the business. Okay, if we think about a house and how we value a house, I think everybody's pretty familiar with the process of determining the value of a house. And when you look at valuing a house, there's kind of three ways. You look at a cost approach and you say, okay, how much would it cost to build this house? You could also look at neighborhood in the neighborhood and see what other houses are selling for, and make adjustments for size or number of bedrooms, those sorts of things, and come up with a value that way. And a third approach under value in a house would say, okay, rather than look at either one of those, let's look at how much income we could make if we were to rent this house out, and how much could we get on from an income based approach to looking at the value of this house. And so when we value a house, we would look at those three things. When we value a business, we do essentially the same three things. An asset approach looks at the value of the individual assets and says, how much could we, if we were to liquidate this company, how much could we sell these assets for, and kind of combine the values of the assets. A market approach goes out and says, okay, we have other companies that are in the same industry, doing the same types of things, whether those are transactions of private companies or whether those are publicly traded companies that kind of operate in the same space. But we can look at those companies and draw inferences, make comparisons, and come up with a value that way. And then the third way, which is probably the most common for business appraisers, is looking at an income approach, figuring out how much money we expect them to make, and either doing a capitalization approach or a discounted cash flow approach, and figuring out, okay, how much would someone pay for that specific income stream? And we'll go into these in a little bit more detail as we go along, but that's kind of a broad brush approach of how we look at the value of a business. So what are some of the key things that we look at? The main thing is, how much money does an owner put in their pocket? I don't know if anybody heard what we talked about at the very beginning, but that's essentially what we're doing. We're trying to figure out how much money does this owner get to put in their pocket, or how much do we expect them to be able to put in their pocket? And so it comes down to earnings. It might be, maybe earnings isn't the best measure. Maybe it's cash flow. Maybe we're looking at dividends. How much are revenues changing? And then the second question is, what risks are associated with the income stream that we see? And so that's where a discount rate or a capitalization rate would come into play. Is, we look at time value of money and we say, okay, that income stream is not necessarily guaranteed. And, there has to be a risk rate associated with it. What is the risk for this company? And how do we then discount that back to present value? Again, we touched on a couple of these. The size of the interest being valued matters. What kind of rights do they have? From a control standpoint, do they have voting rights? Other things that come into play, are marketability or liquidity. Like, how liquid is this interest? When we talk about liquidity, it means how long would it take to get our cash out? Sometimes for a controlling interest, you decide today, hey, I'm just going to be done, and I sell it tomorrow. In the stock market, we can do that very easily. With an interest in a business, if you have a controlling interest, you can make that decision fairly quickly. And, it still takes some time to sell, but it's not typically, 6 months, a year, and you probably have it done. But the flip side is if I have a 10% interest and I want to sell that, there's all sorts of perhaps restrictions on my ability to sell. There might be, issues in terms of the operating agreement, in terms of whether I can sell. And, getting that right person in there could take quite a bit longer than even a year in order to get that specific interest sold, especially if there's no provision that requires, maybe the majority shareholder to buy those shares from me. Okay, asset approach. Typically what we do on an asset approach is we're looking to see, okay, if we were to take the assets of this business and sell them off piecemeal, how much could we get for these assets? In a service type business, like say a law firm, there's really not a lot in terms of the value of a business from an asset. They have a few desks, some furniture, maybe a few computers, but as far as assets that have value that could be sold for value, most of the assets that they have are probably depreciable assets, and they're probably not worth a whole lot. So, but it contrasts that with, say a holding company that owns a piece of real property that's rented out for residential real estate purposes. The value of that residential real estate asset probably is the best measure of the value of that business, because of the value that and especially if it's been held for a number of years, maybe the value of the business has gone up quite a bit. So, a lot of times when we're doing an asset approach, we do kind of adjusted net asset value. And so we adjust the assets to fair market value. Depending on the standard of value, you could be looking at a fire sale, or you could be looking at kind of an orderly liquidation, which that's the more common approach here. But basically what we're doing is we're adjusting the assets to their fair market values. We might need to make some adjustments for liabilities as well. But basically taking into account, okay, what could we really get for these specific assets, and then if we were to sell them, how much could we get after we pay off all of our liabilities? So that's kind of the net asset approach. Again, it's kind of fact specific as to whether or not we would look at this at a specific business under an asset approach or not. A lot of times, it really depends, because sometimes the asset approach is the only approach that really makes sense because of the value of the underlying assets. But then a lot of times as well, there is not really much in the way of assets. And so one of the other approaches, whether it be a market approach or an income approach, makes a lot more sense. So another thing that matters is operating assets versus non-operating assets. Sometimes business owners will have assets that aren't really necessary in the value of the business. Maybe they own a small restaurant, but then they also own a cabin up in the hills. I'm making stuff up, but I've seen it. But those types of things, typically we would separate out the operating assets from the non-operating assets, figure out the value of an operational entity, and then add in the value of the non-operating assets if that's appropriate. Some of the things that we might adjust on the liability side: loans to and from shareholders. Are those really loans, or are they more like equity? Maybe there's a lease that's not on the books that we need to maybe take a look at. Is there a contingent liability? But at the end of the day, what we're basically doing is adjusting the value of the assets and the value of the liabilities, and coming up with the difference and saying, okay, this is what would be the net asset value of the company. Okay, moving on to a market approach. So there's kind of three main market approaches. One would be looking at publicly traded guideline companies. This one can be difficult, but it really depends on the company, because what we're really looking for is comparability. And when we start looking at the value of a business under a market approach, what we're trying to do is find the closest match that we can and figure out whether there is information within those transactions, whether they're publicly traded transactions, whether they're private transactions, or whether it's transactions in the same company's stock in prior years, and figure out whether those are instructive to us in terms of value. So perhaps an example would be, I have a restaurant, and maybe I have 10 or 15 locations for that restaurant. I might look at a publicly traded restaurant company and try to make some comparisons there. We have some databases that we can look at for private transactions, and where those private transactions get reported by business brokers, and we can look at those transactions to figure out what a comparable company might have sold for in the past. And then also, like I say, you have perhaps you have transactions in the same company's stock, whether that was a sale of a cousin's interest or something like that. So but really it comes down to the comparability, and in all three of these cases you can have comparability issues. Even if you're looking at the same company stock, if it's 3 or 4 years old, maybe it's not really all that comparable because the company's changed, or business environment has changed. But really what we're trying to do is figure out how comparable these transactions are to the company that we're valuing, and whether we can make any inferences. Some of the things that we consider are, what industry, what products, what services they offer, how big the company is, where the company's located. A lot of times, maybe something across the country might be comparable. It might not, but it could be comparable. Something in the Europe, maybe not. Company maturity, management depth, those sorts of things all factor into comparability. One of the things, public companies not so much, but for the private transactions approach, we have good, generally speaking, there's a lot of data about the financial metrics of the company that has been sold. But sometimes we don't have a lot in terms of even industry or how they're positioned within the industry. We may not know much about, how long the company's been operating, how many employees they have, the management depth, those sorts of things. So sometimes those types of issues can be a factor, I guess I should say, in terms of how comparable we think a company is. Generally speaking, when we do a market approach, we're looking at multiples, and you guys may have heard the term market multiple before. And essentially what we're doing is we're coming up with a ratio, price divided by some measure of cash flow, and figuring out what that ratio is, and then trying to apply it to the company in question. So we might be looking at price from an equity standpoint, or it could be market value of invested capital, which is equity plus liabilities that were assumed in the transaction, and then comparing that to a cash flow measure, a net income measure. EBITDA is a pretty common one. EBITDA is earnings before interest, taxes, depreciation, amortization, and that's a pretty common metric that gets used in valuations a lot. Again, we kind of touched on past transactions, but sometimes an offer from an interested party can be instructive. It depends a lot on some of the factors that go into some of those transactions, how recent they were, what were the terms, were there with related parties, was there some sort of family discount that was given, those sorts of things, in terms of figuring out what the value might be from those types of transactions. Okay. Income approach. So for a lot of companies, this is kind of the bread and butter, because in the market approach, sometimes it's difficult to find comparable companies. And so, those end up getting thrown out. And the asset approach, a lot of times, will get thrown out because it's not really applicable. And so we're left with an income approach. And so this kind of is the bread and butter. And what we're really trying to figure out is, again, a projection of earnings. How much does the company make? and then a measure of risk, the kind of the discount or capitalization rate in terms of bringing that, projection back to present value in terms of valuing the business. So some of the things that we look at when we're looking at projecting earnings, first of all, we'll look at the history, figure out, is the company growing? Is it dying? If it is growing, is it growth related to specific revenue segments? What's happening with expenses? For a lot of companies, labor is going up quite a bit right now, and revenue is not necessarily matching that growth. Hopefully that's normalizing. But, within the last couple of years, I think expenses have been growing a little bit faster than revenues, even in some cases. So, really what we're trying to do is put together a projection of earnings. And then we need to kind of look at these non-operating expenses, owner perks. Is the owner's wife, do they have their own gas debit card? Is that something, does she work for the company, or does she just gets to drive the company car and put gas in her car on the company's dime? It seems like every owner has a family cell plan, and how much of that is really used for the business versus how much is used by their family. All sorts of examples of how owners take money out of a company that maybe don't necessarily relate to operating the business. And then another one is, is the compensation that the owner is paying themselves, is it reasonable? Some owners like to pay themselves very little. Maybe they have an S corp, and so they're trying to pay the bare minimum to themselves so that they're minimizing their payroll taxes. On the other hand, there's some owners that pay themselves way more than they're worth. Maybe they don't even work in the business, but yet they're drawing a salary. And that's another thing that we kind of take into consideration. And again, it kind of goes back to, what are we valuing? If we're valuing a minority interest, we may not necessarily look at these things in as much depth as we would if we were looking at the value of a controlling interest. But these are types of things that we might consider when we're looking at the value of or projecting that cash flow. And then once you come up with earnings, maybe you make a whole bunch of adjustments to expenses. Another thing, maybe I failed to mention a little bit, sometimes there's non-operating or items that were not expected to continue. One thing that a lot of businesses had in 2021 was a PPP loan that put a big number to the bottom line, but that's never happening again, or at least we hope it's never happening again. And so that would be something that we might adjust out as well, because it's not expected to continue in the future. But even after we get to a projected earnings number, we still need to figure out, okay, is that number going to reflect what an owner can put in their pocket? You might have non-cash expenses like depreciation or amortization. You also might have to put money into capital expenditures that that money is going to come out before you're going to put money in your pocket. There might also be working capital needs. If the company's growing very quickly, you might have to reinvest in inventory, or in, a bunch of money is maybe not going to drop to the bottom line immediately, but rather it's going to, your accounts receivable is going to increase over time. And so that's money that, kind of needs to be put back into the business before the owner can pay themselves. And then another item would be whether debt needs to be paid down, or whether there's going to be debt proceeds that might increase the amount that's available to the owner. So those are some things that we consider when figuring out, going from earnings to cash flows. And once we have a good cash flow base, then we'll either use a discount rate or a capitalization rate to figure out what the value of that business is, on a net present value basis. A discount rate is used if we have a series, maybe we're projecting out 3 or 4 years, 5 years. We'll use a discount rate to bring all those cash flows back to present value. If we have a fairly stable business, we might just use a capitalization rate, and basically that's a single period model, where we're assuming that the cash flows are fairly stable over time, and we're just going to bring that back to present value in one fell swoop. Kind of a math thing, but one of the key differences between the two, whether we're doing a discounted cash flow or a capitalization, kind of depends on how stable we think those cash flows are, or whether they're going to change over the time. And so yeah, we'll figure that out. So how do we come up with that discount rate? It usually is made up of these 5 things: a risk-free rate, which is typically the rate of return on a long-term U.S. Treasury, an equity risk premium, which kind of comes from data in the stock market, a size premium, an industry risk premium. Those 3 are all data that kind of come from the stock market, and so we'll look at what the premiums are for equity, for size, for industries, and kind of get a feel for what that is, and then we make an additional adjustment for company specific items. And these are some of the factors that we consider. But do we have a really concentrated customer base or a concentrated supplier base? Do we have too much leverage, not enough leverage? Do we have a really key person that brings in all of the revenue? Do we have competition that is pretty specific, or maybe we have no competition, and so that gives us a competitive advantage, and so we're maybe reducing the risk for this company because of the fact that there is no competition. But those are types of things that we'll consider. For a lot of companies, discount rates right now are around 20% for a privately held company. Can be higher or lower depending on how risky the company is, how new they are, what those cash flows look like, and those sorts of things. But in today's economic climate, 20% is a fairly reasonable estimate. Okay, so then we have to kind of put it all together. Once we have a value from the asset approach, a value from the income approach, and a value from the market approach, we kind of put those all together. What makes the most sense? Do we have contingent assets, contingent liabilities? Do we have non-operating assets or liabilities that need to be considered separately from the operating value of the business? And then we start looking at discounts to the value of an ownership interest, and the 2 most common are a discount for lack of control and a discount for lack of liquidity, or a marketability discount. And so typically an owner that owns a minority interest will not pay the full pro rata value of a business, for the value of their shares, just because they don't have that control. And then again, liquidity refers to how fast am I going to be able to get my money out of this business? If I make an investment, how fast will I be able to get out if I need to? And so a lot of times there's a discount for one of those 2 things. And this kind of comes into play with mostly for minority interests, although sometimes a marketability interest will apply to a controlling interest as well. it just kind of depends on the business itself. So, all right. It looks like we've still got a little bit of time. So I know it's a little bit of a fire hose. We put a lot into, kind of into this, but I wanted to maybe touch on a couple of just case studies, evaluations that that I've worked on over the years that maybe would give a little bit more context into how we would go about doing this. So I worked on a dairy farm a few years back. Dad and his cousin owned the business 50-50. Both of them are looking to retire in a little while. Their two sons and a cousin's daughter is planning on inheriting and taking over the family business. And so, they were coming to me saying, okay, how do we do this for estate tax planning purposes? They had an attorney that they were working with that was helping them do the transfers. The two sons and the daughter were actively involved in the business, and so that wasn't an issue. But it was, okay, how are we going to transfer this to them? And what are you looking at? So the first thing that we looked at was, okay, what assets do we have? And the two main assets were the real property. They owned, a pretty big chunk of property, and then they had, several hundred dairy cows that they, their herd that produced the milk. And so they had a little bit of milk sales, and they grew a lot of hay, alfalfa hay. And, most years they were able to sell a little bit of hay on the side after meeting the needs of their herd. And so they did have some hay sales in most years. And so that was kind of where the income came from. So what we did, first of all, we got an appraisal on the real property because we wanted to know how much that real property was worth, because that had a big impact on whether this was worth more dead than alive, right? I mean, maybe it's worth more if you just sell the business, sell off the property, sell off the herd, and kind of look at it that way. But we looked at it that way by getting an appraisal of the real property, and then we came up with an estimate of what the worth of the herd was based on the average age, and kind of market pricing for cows in the marketplace. Mostly cull cows, but it was something that we looked at as well. So, and then there was some shareholder loans on the books that we wanted to take a closer look at to see whether they were really loans or whether it was more of, hey, we just took some money out and called it a loan and never intended to pay it back, which that was the case in this instance, where they had taken some money out and called it a loan, but it was still on the books for the same amount, 10 years later, and they hadn't made any payments whatsoever to, pay those off. We did have a market approach, in the sense that part of there was a cousin that had been previously involved in the business, where it had been a third, and the dad and the other cousin had bought his interest out. It looked like to us that it was kind of a family discount type sale. The cousin wanted out, and they just came to some sort of agreement on how much his shares were worth, and so it didn't really, in our opinion, reflect fair market value, so we did not use that as a market approach. And then we also looked at an income approach. So we looked at the number of cows. We figured out, okay, what's the milk yield, and how much time are they going to be in production, in milk production? How much, what's the age of the herd? Is the herd turning over correctly? What do we expect in terms of milk prices? And then, look at hay sales and how much hay do we think we'll be able to sell in the future. And so all of these items kind of went into figuring out what do we think the revenue from this dairy operation is going to be in the future. And we worked pretty closely with management to try to figure a lot of these things out. But that was kind of what it went into the revenue expenses. We did feel like the owners put a little bit more labor in than the new owners, and so there was kind of this expectation that they were probably going to have to hire somebody else to add to the labor pool in order to meet the needs of labor for the company. But then there was also some owner perks that were kind of unrelated to the business. They were paying home utilities, certain professional fees, and some travel and entertainment out of the business that really wasn't expected to continue, or really wasn't related to the operation of the business, I guess I should say. And so we removed those to try to get a little bit better feel for what the actual income was. So we made a couple of adjustments to the expenses. And then in looking at the discount rate, they're dairy farmers. They didn't have a lot of business acumen, but they were really good at what they did. But the other thing that was really a big factor was they only had one customer, essentially. They sold the dairy milk to one customer. Given the industry and given the need for milk, we didn't think that was a huge factor, but it was certainly a factor in terms of determining the discount rate. So at the end of the day, the asset approach and the income approach actually yielded results that were pretty similar. We had a business that had a bunch of assets, but we also had cash flows that yielded a value that was actually fairly similar to the asset approach. And so in looking at it, we kind of blended those two approaches to come up with our opinion of value. And then we also looked at a discount for lack of control and lack of marketability, because again, what was being gifted or put into the estate plan was kind of this minority interest in the business. And so we took a discount for lack of control and a lack of marketability in coming up with the value of that business. So okay, a second case study, and I've actually worked on several of these over the years, but I have an HVAC business, heating, air conditioning business, looking to sell and retire. They didn't really have, I think they had one son and one daughter, but neither one of them were interested in taking over the business. So they wanted to know what the value of the business was so that they could figure out, how much to sell it for. So that was the context. Looking at, some of the business facts, they have quite a few trucks, they have a lot of equipment, they have a decent amount of inventory. And then they had a warehouse that was held in a separate entity. And they were trying to hold on to this and just rent that out to the new business owner for retirement income. We didn't really look at the value of the warehouse, but rather we were looking at the value of just kind of the operating entity. And then From an income perspective, they got about half of their income from residential new construction, and then half of their income came from residential service, where they're going out and servicing existing systems. They didn't really do much in the way of commercial, so that was kind of the facts in terms of figuring out comparability when we start looking at comparables. We decided in this case that the equipment was pretty old, the trucks were pretty old, that there was inventory, but there wasn't tons of inventory. And so to kind of look at this from an asset approach didn't really make a lot of sense. And given the fact that most of their business was residential, there wasn't a ton of accounts receivable either. The accounts receivable that they did have was related to the new construction, because the service was all kind of pay on demand as the work was done. And so there really wasn't tons of accounts receivable either. And so we didn't really feel like the asset approach was all that applicable. But when we looked at the market approach, we were able to find several similar sized HVAC companies that had been sold. And so we calculated values using 3 different multiples: market value of invested capital to revenue, net income, and EBITDA. And so we used kind of those 3 approaches to kind of look at what the value of the business was when comparing this business to the other HVAC businesses that we were able to find in our database. So, and then we also looked at an income approach. A couple of things that we looked at quite heavily was, what does the new construction market look like in this area? Is it something that was going to, continue? Or did we expect kind of a downturn? And then kind of an analysis of the service industry. One of the things that was kind of applicable for this company was, with the new Inflation Reduction Act, the oxymoronic name of that bill, but essentially they're pushing a switch to heat pumps. And so for this company in particularly, we expected that the switch to heat pumps was going to give a pretty good bump for the next couple of years in terms of service and new installation, as existing customers decided to switch over to using a heat pump instead of just their normal AC unit. So that was kind of what we looked at from an expense standpoint. One of the things that we talked to the owner about was how hard it was to find trained employees, and having to pay substantially more in wages in order to find good employees. And then we made adjustments to some of the expenses based on non-operating assets. He had a razor and an RV that were being expensed, or they were actually owned by the business, but also some of the expenses for those assets were in the business expenses, and so we had to remove some of those. Again, there were some fuel expenses that we changed, and then also some family cell phone plan adjustments that we made. I think there was a couple other adjustments, but they were relatively minor when considering these types of things. But basically, we put together an income and expense projection based on some of these factors that we found in the business. In this case, the market and income approaches yielded fairly similar results. We didn't really need to look at lack of control or marketability considerations, because the purpose of doing this was to say, okay, how much is this business worth? How much do we want to sell it for? He did own 100%, so there was no lack of control issue. Marketability issues were minor because he had access to the cash flows over time, and then also there was the fact that he could just decide to sell when he was ready to sell. So yeah, we're kind of at the question phase. So I'll again, hopefully this was helpful. I enjoyed giving the presentation. I'd love to answer some questions. Hopefully we have a few here that we can kind of go through. But I'd love to talk with anybody that needs a business valuation. And you can schedule a free consultation with me as well. Even if all you want to do is just toss around some ideas or things that you want to look at. But obviously, if you're in a litigation situation, if you're looking to do an estate plan where the business is a significant part of your estate plan, I'd love to help you and do evaluation for your business so that you could get that done and get it done right. So Don, what do you got for me?
Well,
I feel like I've just been talking and talking.
that's the peril of talking to a screen instead of a live audience. I mean, not that we're not live. It's just it is frustrating, isn't it? Where you don't see people's faces, and maybe we ought to turn that on for people. I don't know. So Matthew's asking, how does putting a minority interest into a trust? I think you answered that one live, didn't you?
I tried to. Did my answer make sense? I guess is part of my question there.
Yeah, and Matthew, what we teach at the 3-day summit is you always take your business interest, whether that's a corporation, limited partnership, or an LLC, and we always tie that somehow into a revocable trust. And the example that I've often given is I helped a lady. It's now been 4 or 5 years ago, 38 years old. Her and her husband own a Texas or a water drilling company in Texas. He dies in a rodeo accident, leaving her as a 38-year-old widow with 4 little kids. And oh, wait a minute, they didn't own the business. He did. It was a single member LLC. Well, he's dead. Who owns the business now? It's going to have to go through Texas probate to figure out that she owns the business. And that business may not be worth $4 million after Texas probate gets done with it. So we always tie your interest of a corporation. We tie the stock to a trust. We tie your interest of an LLC to a succession plan. And maybe it's simply a designation of successor and interest clause in the operating agreement that says, Talon is the member of all the days of his life. The second he dies, he wants all his interest to go to somewhere. But without that, it's going to go. So we always tie it to a trust somehow. But is Matt or Talon, is that what you think he was talking about?
Yeah, but I mean, when we talk about a minority interest, again, the example I typically give is if I own 100% of a business and it's $1 million, we have we have a $1 million business, but if I only want to buy 10%, or if there's a 10% ownership interest in that business, I'm not going to pay $100,000 for a 10% interest if the whole thing is only worth $1 million. And the reason why is because, number one, as a 10% owner, I can't control what happens to the business. I have no say in when distributions are made. I have no say in terms of what management decisions are made. And I don't typically have a I don't have control, and I don't have control over the timing of when I get my money out. And so because of that, I might pay something less. if the entire business is worth $1 million, maybe I'll pay 70,000, maybe I'll pay 60,000. And so for a 10% interest. And so when we talk about gifting out of the value, so if we take a gift and we put a gift in into a trust, we can typically put it in for less than the pro rata, and then hopefully at the end of the day, there's more value coming out, and hopefully as well the value of the business grows while it's in the trust as well. And so that's a way to get it out of the estate first, and then have it grow within the estate and pay less in taxes at the end.
Great. Thank you. Okay. Richard is asking, first of all, wow, that was a fire hose. Does a potential buyer really go through this much detail in analysis prior to an acquisition? Or is this really to satisfy a lender? Your thoughts on that?
Well, so and looking at the rest of the question as well, it really kind of depends. I mean, it really depends on the buyer. Like if we're looking at private equity, absolutely, they go through this much and maybe even more analysis when they're looking to buy a business. I've seen, deal sheets and some of the stuff that people get when they're going to go through this acquisition, and the Dropbox folder is gigabytes big, because they're looking at everything. Sometimes it is to satisfy lender requirements. Sometimes it's to meet the appraisal best practices, especially if we're in a litigation matter, a highly contested litigation matter. We kind of have to look at all this stuff, because if we don't, we get up on the stand and we try to testify as to the value, and somebody on the other side is going to fillet me. And so, but it also, it can it can be less, right? I mean, if we have an estate plan where we're, hey, son's involved in the business, we're just trying to transfer the value of the business to the son, and maybe provide for some retirement income for mom and dad. We're just trying to get a general feel for what the business is worth. We don't have to go through all of every single one of these steps in that type of case, but it really is, kind of fact specific, and what are we doing it for and why, and who are the parties that are involved? Is it amicable? Is it not amicable? So that there are a lot of things that can or don't have to go into something like this, for sure.
Great answer. Thank you. And Richard, thank you for your question, because it's something that I think is on everyone's mind. And Talon, if they wanted a consult, go back to your screen on that.
Sure.
There it's right there. What are they to expect? This is a free consult. I don't know how we could make it easier for you.
Yeah.
And could we get a reduction in your price, please?
Yeah.
Cannot make it easier, but you'd simply go there and that website. Oh, we lost it.
We lost it.
Yeah, there we go. And on that, it's simply asking for your contact information. We're not gonna sell it to anyone. It's for a free business of a free consultation. And then what?
And so, basically what I would want to get from you is a little bit of information about, what are you looking for? Why do you want to know the value of your business? What's the context? Some of those questions that we talked about at the start. Why are we doing it? What do we want to know? Is it the value of a specific piece? Is it the value of the whole thing? Are we doing it for gift and estate tax? Are we doing it for divorce? All of those types of questions would be things that I would ask in that consultation, and then we could, customize the offering to what you need and why. And so, and I think I saw a question on pricing, just
Yeah,
from a broad brush approach. I do a couple of different things: full valuation, written report, top of the line, something that I'm willing to take to court. It can be somewhere between 7 and 10,000 to get something like that done. And even more sometimes, depending on how at odds the litigation is, and how much it's going to be, to try to get a handle on all this stuff. But I also do what I call a calculation of value, where we look at specific approaches. We'll say, okay, we're going to look only at the market approach and the income approach, and we're going to do this on kind of a, what I call a quick and dirty or back of the napkin type approach, where really we just want to know and get a good idea, so that if we go into this negotiation with our son, or we go into this negotiation with our parents, how much, what's the range, and what should we be looking for. And usually something like that is going to run somewhere around $1,500 to $2,000, to get a good feel for what the business is. And I can do anything in between those two. Sometimes I've had people, and in fact, I've had people call me and say, hey, I got this other valuation. Can you spend 2 hours looking at it and give me some feedback? And, in those instances, I just bill by the hour, and, send them a bill for $500 or whatever it is, and give them, just kind of a second opinion on what I think of the valuation that they've already got. So
what a valuable tool, and anyone, and I was surprised at because I've always thought of value in your business when you go to sell it, but there's so many other things. Divorce is certainly. How big of a business? How big is that for you? Are
I
percent?
percentage wise, I would say, from a percentage standpoint, I would say probably 50 to 60% of the work that I do relates to litigation somehow. Um,
Wow.
and then the other 40% probably is more along the lines of, gift and estate tax planning, type work. So
Okay. Um, Common misconceptions or mistakes people make when valuing their business.
I think a lot of times people, I think the biggest one for me is that they'll just use a general industry rule of thumb. People hear, well, it's 3 to 7 times EBITDA. And,
Yeah.
and, oh, I mean, if you look at a bell-shaped curve, I would say that, two standard deviations, it probably falls in that 3 to 7 times EBITDA. But if you have a company that has $1 million of EBITDA, that 3 to 7 times is a huge difference between 3 million and 7 million, in terms of determining the value. And so, I mean, it's not that it's not instructive, because it is. It's just, how close of a number do you really want? And I think when you're getting ready to sell your business, or when you're, when you're buying out a partner or something like that, you definitely want to get as close as you can, because there are big numbers involved, right?
Absolutely. Okay, question. Once you evaluate a business, do you have access to potential buyers?
Um, yes and no. I'm not. I mean, first of all, I'm not a business broker, so I don't do that side of the deal. Um, I do know business brokers. I can certainly put you in contact with certain business brokers. Um, I also I've been in this industry long enough that I know a number of people who are always looking to buy. Um, sometimes the best person to buy is your competitor down the street. A lot of times they are somebody who could be the best place to sell. And sometimes that's hard for people. You've gone up against them for so long that you don't necessarily hand over anything to them. But
Little pride
sometimes,
issue there. Yeah, I get that.
but at the same time, like honestly, the strategic sales are the ones who get the most out. Um, and so maybe it's not the competitor down the street, but maybe, if you're local to, say Denver, you find a business owner who is in Salt Lake and wants to expand, and maybe that's somebody who would be interested, because the strategic buyers always pay more. So if you're a business owner, that's who you want to look for to buy your business, is the strategic buyer, because they tend to overpay.
Okay. Kenneth is asking, if you're a service business where you are the business with few expenses and no debt, is it 3 times net or income or similar valuations? Or I guess it would depend on a lot of factors, but what's your general rule?
Yeah, and I think that's again, that's kind of one of those that I would say that's probably an industry. I mean, sometimes the industry rules of thumb become so ingrained in the industry that they become the de facto values. But I would say it's probably worth a at least a phone call with me to kind of kind of look at that, because uh, it can vary so much from business to business, you know, because of all the different factors that go into determining what the value or what somebody would pay. It's definitely worth at least a phone call to say, okay, does this make sense in this situation? One times revenue is a common one for service businesses. 3 times net, 5 times net. Those are fairly common. Um, and again, it kind of depends on what you need it for, and how bad do you need it.
Okay. Don is asking a very similar question. Is it difficult to evaluate a single provider healthcare business? No assets, very little expenses, provide contracts with healthcare providers, Medicare certified. Okay, we're getting specific, and maybe this ought to be a personal consult with
Sure.
Talon.
Well, but
Um,
let me answer that
yeah,
kind of sort of, because one of the biggest issues you run into with a service provider is how transferable is it? I mean, and medical businesses are a little bit more difficult, because if I go to my doctor and he says, hey, I'm selling my practice to so and so, I may go there, and if I like him, I'll stay. But if I don't like him, I'll probably leave and go somewhere else. And so then it becomes a transferability, or a transferability issue. And how easy is it for me to go to somebody else? If I'm kind of locked in by an HMO, and you're kind of the only game in town, as far as your specific medical specialty, yeah, it's probably fairly transferable. The flip side is that if you're an MD, and there's 100 MDs in town, and they all take the same insurance, it's pretty easy to lose that as well. So
I've always felt, like a dentist. You go to, I've been with our same dentist for years. He's retired now. I'll try the new dentist one time, but if he has bad breath, or he's got a receptionist that hates people, I'm
right.
not going.
For sure.
And the value of the business goes way down on that. I don't know. Pamela, I don't understand your question for lender requirements. I do you know what she's talking about there?
Uh,
Pamela, maybe you can
I
clarify.
I have done a couple of valuations for like SBA loans. And so sometimes the SBA has specific lender requirements that they want. Um, and so I'm not sure if that's what you're asking, but yeah, sometimes there are certain specific hoops that you have to jump through when you're doing an SBA valuation.
Okay. Okay, we've got two questions left, which is good because we've only got 3 minutes. So let's see how fast we can do this. Richard, I would imagine you're valuing a business at the moment in time. Not so sure how you might use this reference projected earnings. With the internet affect implications, tax law, government changes. Um, Maybe you can read that.
Yeah. Yeah, for sure. I mean, figuring out projected earnings is the most difficult part of the process, and um, depending on if if it's in a litigation context, I might have a lot of help from management, or I might not have any help from management because I might be trying to do it blind because I don't have access to the side of the business that actually runs the business. But it's one of the most difficult parts of projecting and looking at the value of a business. Can we really do it? Look, I'm not going to be so egotistical as to tell you that I can predict the future. I can't. I but I do it every day, or at least I try to do it every day, because that's what a business valuation is, right? I'm looking to, I mean, nobody pays, like if I'm buying your business, I'm not going to pay you a dime for what your business made yesterday. That's money that's already in your pocket. What I'm paying for is the expectation that I'm going to be able to continue to make money from that business and put money in my pocket in the future from the moment that I buy it, as long as that business exists. It is definitely easier to do with some businesses than others. A gas station, a restaurant, a restaurant that's been in operation for a long time. Those types of businesses, they end up being fairly stable in terms of their ability to produce cash. Um, Other businesses, especially, brand new software as a service type businesses, it can be very difficult, and knowing what the market is going to look like in the future can be very difficult. And but we do the best we can, and we try to see what other market participants are doing in terms of figuring out what that projection is going to look like. And really, that's all anybody can do, right? Is they do the best they can with the information that they have and try to come up with the right answer with that approach.
Helen, it sounds like it, if I've learned anything tonight, it is much more complicated than I would have ever imagined um, to set a value for a business. Um, John is saying, my company assists companies in raising capital. We have to evaluate, we must value a company before we can make a public offering. We have clients with minority owners and even loans from family friends. And you've talked about that as well, that maybe haven't been paid back. Can you assist in valuing these types of situations? I think you've been very clear that that's what you do.
Yeah, I definitely would be. I'd love to talk to you, John. If you could, fill out the form and set up an appointment with me, I'd love to talk to you about it.
And Charles, last of all, what about retail?
Um, Retail is another tricky one, and it partly depends on what the product is. Is it a department store? Is it a retail boutique type shop? How well are they positioned in the retail space? What's the environment around that retail location? All those types of things go into figuring out, what that retail is going to look like in the future. And so, again, I wish I had a crystal ball, because it would make my job a whole heck of a lot easier. We take all the factors that we can, and we do the best we can in terms of trying to figure out what the future is going to look like. And then, a lot of it is, kind of based on what they've been able to do in the past. I'm not going to lie and say, hey, but we look at the past and say, okay, what does the future look like based on what we've seen historically? And then, try to make adjustments for things that we see in the business itself. Maybe this particular retail space is dying, or maybe it's a new and growing area. Those are the types of things that we try to take into consideration. So,
Helen, so grateful for your expertise. 20 plus years in evaluating, valuing businesses. Thank you for sharing with us tonight. Students, we've offered a free consultation with the best expert we can find in the nation on this. Please take advantage of that. If this is something that you're interested in valuing your business, or valuing a potential business you're interested in buying, or in your situation where I've got to know the value, please take advantage of that. Talon, any closing remarks before we leave you?
Just again, thanks for having me. I appreciate the opportunity to come and talk, and I hope that you've learned something. I hope that it's been helpful for you. And whether you use me or not in the future, hopefully you're better off for having attended. So thanks.
Thank you very, very much for being on. Students, we appreciate you sticking with us all the way till the end. Thank you, and have a very, very good night. This recording will be sent out to everyone who registered for the event, but don't expect it tomorrow morning or tonight. It usually takes about a day for that recording to hit your email. So thank you for being here. Have a great night. Bye-bye.